Today, we're looking at a property investor who is 22 years old. He had a dream. He wanted to own 30 properties. By the age of 30, he actually put his plans on hold recently as he struggles to deal with interest rate rising and how the internet had no sympathy for him. So let's dive in. Let's look at the details. We're also going to look at if it was plausible or possible for him to get to 30 properties by the age of 30. So let's dive in, starting from the top and having a look at this one here. So we've got Morgan, who he's 22 years old. He's actually put his plans of building his investment portfolio on hold, given the recent rate rise of the 0.5% we saw in July. So that's equated to another $300 per month on mortgage repayments on his property portfolio, worth about $1.2 million in lending there. And he mentioned he's kept his loans variable, which allowed him to provide equity for future purchases. Now, remember that one here, because I do want to circle back to this in the future and myth bust this one here, because there are ways you can still release equity even if your loan isn't variable. Now, many Aussies had been unsympathetic for the would-be property mogul, calling him greedy, I guess, given his plan. So the Reserve Bank actually has hit a 3-year high in terms of the cash rate, where we're at 1.35% at the moment. We've talked about that in the past. We've seen 2 rate rises of 0.5% in the last couple of months, and before that 0.25%. So it was this investor's dream to own 30 properties by his 30th birthday. They're being shattered by the Reserve Bank's latest rate hike, and many Aussies are unsympathetic. Now, I do want to uncover if it is plausible for Morgan to be able to hit 30 properties. And I will show you the borrowing power a little bit later, because we do get his income disclosed, or at least an understanding of what he's getting paid. So I'm going to cover that one a little bit off later too. But going further into this, he bought 2 properties last year, spending, his hopes were to spend another sort of $1 million this year on property investment. But he's actually put it on hold with the Reserve Bank's recent rate rise. So I guess this 20-year-old had very lofty ambitions on what he was hoping to achieve, and the Reserve Bank's recent rate hikes have put a stop to that. We know Phillip Lowe, the Reserve Bank governor, had said that he hadn't had plans to increase rates until 2024, and whether that played into Morgan's plans in his investment portfolio is, I guess, yet to be seen. But he did talk about the fact that he was committed to variable loans so that he could use the equity in his existing properties to buy more in the future. Now, I do want to unpack this one firstly. So there is a misconception. You do not need a variable loan to be able to release equity. And I think this is where potentially Morgan's gone wrong. He's gone variable on his loans. But in this situation whereby you've got a property. So he does go on to say one of his properties he purchased was $467, and he put a 10% deposit down. If you'd fix this loan in here, you can always still release equity out. So him going variable didn't really make sense, because particularly when he bought last year, the fixed rates you were getting were anywhere in the low 2s for an investment property. So what he could have done was set up his loan there, and then in the future, when the property value has gone up, set up a sub loan for an equity release, which wouldn't impact that existing loan there. So I think potentially misinformed there that he had to be on a variable rate so that he could release equity. So he says further on that he sticks to a variable rate so that he doesn't have to break the fixed rate. So as I said in that example there, you could absolutely access equity without breaking that fixed rate. So if that was fixed already, that loan would remain as is, and we would release that equity as a secondary sub loan. So yes, he talks about the fact that he didn't want any increased costs with releasing equity because of his plans to buy properties. He also talks about the fact that the increase in July meant that he had an extra $300 per month on his property loan portfolio of 1.2 million. And I tend to agree with that. So let's say he was paying 1.2 million in debt. His interest rate was 3%. His repayments, principal and interest are about $5,000 a month. A 0.5% increase brings those repayments up to $5,389 per month. So I can see what he's talking about there, the rates going up. So this is where I want to talk about his borrowing power. So he's a senior property investment specialist at a company called the Maple Property Group, and he lives at home with his parents. And he says he's got a very strict budget where he sort of tries to save every penny to the cent. So he earns roughly just above the 6 figures. So let's just say he's on 100 grand, and he secured his first loan by putting down a 10% deposit as well as paying mortgage insurance. We do know that a lot of Australians have shown little sympathy to the would-be property mogul, and they've all, or many have called him greedy. So there's a lot of comments on the internet, people having no sympathy for him, saying that people like this artificially inflate the market, that they really have no sort of sympathy. There's been some sarcastic remarks talking about setting up a GoFundMe page, which is, where they can give him money to help him buy his 30 properties so that they can go without eating. There's a lot of spicy comments online we're seeing, but I guess I do want to go back to his borrowing ability and how that would work. So remember that he did say that his income was in the 6 figures, low 6 figures is what they said. But I just want to quickly show you one thing here, that he bought his first property, which is a 4-bedroom home, which was $467,000 in the outskirts of Melbourne. That was in May last year. And then he bought another property in Ipswich in, I think it was later that year, 2 months later after he purchased his first one for $485,000. So we do know he's got 2 properties, and it sounds like he used the equity in the Melbourne property to purchase his other one. So I just want to talk about his plans to buy 30 properties. Is that possible? So he was on low 6 figures as an income. Well, what's his maximum borrowing on 100 grand? Let's say he's getting $1,000 a week, so 52 grand in rental income. Because he's living at home with his parents, the banks would actually say there's a nominal rent that he has to pay. Even if he's not paying board, we have to put down $650 a month. So let's say he's got no liabilities. He said he lives frugally. What is his actual borrowing power? Could he continue? Well, the answer is he's probably maxed out on his borrowing capability now. So his dreams of being a property mogul would be pretty challenging at the moment based on his limitation on borrowing capacity. Now, this is a high level sort of summary of what it might look like. There are things that could change this ability, and some lenders have higher borrowing power than others, but this gives us an idea on where we stand. Now, if we see that for 2 properties, he needed to borrow $1 million, for him to get to 30 properties, he'd actually need to borrow $15 million. So how much of an income would he actually need to get to his target of 30 properties by the age of 30? Well, he'd need a remarkable improvement on his wage. We need his income to be $2 million, which is absolutely insane. You might need to become a surgeon or a medical professional whereby he could get that up. Plus getting $500 a year in rent. These numbers are absolutely staggering, that, to be able to borrow $15 million, that's the sort of money that he'd be needing to borrow. Because as we know, the banks nowadays look at 2 things. One is equity, which maybe he's got a heap of equity, but the second is borrowing power, and that's purely driven by income. So I think his lofty ambitions of getting 30 properties by the age of 30 was always going to be a potential struggle. So the article goes on to say that he was speaking with his broker and he's talking about changing his loan repayments to interest only. I guess that's his call there. Something to be careful of with interest only repayments is that he's actually not going to be paying down the loan. So in his area, such as Melbourne, where we've started to see the values of properties decrease, he might find that the value of his loan is equal to the value of his property. So if you're doing interest only, you're not really going to see any of that principal pay down. So probably something to think about there. They did go on to talk about, they had a survey recently of 1,018 mortgage holders, where 3/4 of younger Australians are looking to switch part or all of their loan to some sort of a fixed loan setup. So we'll talk about fixed and variable rates in a little bit, but that is interesting to see. The study also talked about a whopping 77% of the respondents under the age of 30 wanted to restructure loans, compared with 55% from 35 to 49 and then less for 50-year-olds. That makes a lot of sense. I think the younger borrowers out there have higher debts. Also, if you're under the age of 30, you probably started a family, you might have kids. So your ongoing household expenses might be a little bit higher, and restructuring will help you sort of alleviate a lot of that. And it also goes on to talk about that. Yeah, so younger borrowers are more likely to have larger loans and be stretched. Now, we saw in July, so earlier last week, where there was a 0.5% rate rise, which is actually the highest the Reserve Bank's cash rate has been in a very long time. We saw 2 rate rises of 0.5% in June, and then this month in July, and also one in May. So we've seen over 1.25% increase in rate over 3 consecutive months, which actually has been the steepest sharp since 1994. So now the Reserve Bank has raised 3 consecutive months in a row, and we actually haven't seen that since 2010. And we've been hinted that there's probably more pain to come for a lot of borrowers in the coming months. Now, as we saw with Morgan, that increase meant $300 a month just for the July's rate increase, and equally for borrowers. Let's say you've got an average mortgage of $600,000. The increase we saw this month is going to mean an extra $163 out of the pocket, out of the budget each month towards your mortgage. Now, in terms of the bigger banks, they're sort of expecting, so CommBank's expecting the cash rate to hit 2.1% by November. Keep in mind, we're at 1.35%, so still a lot more raises to come. NAB sort of saying we'll hit the same rate by December. Westpac saying we'll hit 2.35 by February next year. And ANZ pretty hard in the sense that they think things are going to go up quite a lot to 2.6% by February. So what does this mean if you're a mortgage holder? So there's a couple things you can do. One is seek advice. So we are a mortgage broker. We're based in Brisbane. We deal with people Australia-wide. But did you know we can actually help? If you're based in Sydney, you're in Perth, you're in Adelaide, and you have a mortgage, or you're thinking of getting a mortgage, we can help you. We can review your mortgage, see where you're at, see what's going on, and look at what can actually be reduced. I had a client recently whereby their rate was at that 3.5% mark. We're able to pull off 0.5% in terms of bringing the rate down by 0.5% plus, so get them to 2.99, plus get them a fixed rate where they were really comfortable. They wanted to split the loan between fixed and variable, and also on top of that, get a cash back. So I think the first step is definitely seek advice. Hit us up, certainly happy to help. And then weigh up the pros and cons of the fixed rates and variable rates. We know variable rates are likely to keep increasing in the short term here. So if you're worried about that fluctuation, you're not comfortable with rates moving up and down, well, then that's where fixing gives you that stability and knowing what you're up for, knowing what's going on, and you can sort of budget around it. So probably understanding the pros and cons of each. Fixed rates, you can't typically pay more than 10 grand in additional repayments during the fixed term. But if you split it, you can get the best of both worlds. So it's probably understanding that. Fixed does have a bit of a premium at the moment. So we are seeing fixed rates are about 1.5% higher than your variable rates. But the steep increases on the cash rate at the moment is becoming a tough one to call, because previously we were thinking, well, it depends on, the spread is too large. You're paying the price up front for a fixed rate compared to a variable. Now, as we're starting to see the Reserve Bank being a little bit more aggressive to 0.5% increases, we are getting customers starting to really seriously think about the fixed rate again. The third step is to have a bit of a loan strategy. So that includes understanding your costs, understanding where you can make extra payments to pay off the loan faster, and talking about your household budget, looking at things you can cut out of it month to month to pay down the loan faster. The fourth is to have a debt strategy. So if you have credit cards or car loans or leases, looking at ways you can consolidate that so you have a more manageable household ongoing expenses. The fifth is, we'd always say if you are thinking of refinancing, there's lender's mortgage insurance involved. It's probably not a good idea. The good news is if you had paid mortgage insurance with the lender you're with, that is credited. So if you set your loan up with Bank A and you're staying with Bank A to do a debt consolidation, and you'd previously paid 10 grand in mortgage insurance, well, that mortgage insurance is a credit to you as long as you stay with Bank A. So if you re-lend and you've got a new mortgage insurance premium of 9 grand, well, because you've previously paid the 10, you get that credited, so you don't have to pay that again. So typically we'll avoid mortgage insurance at absolute all costs and look at ways to reduce that. And then the last is just to be aware of lender promotions. There's a bunch of promotions going on at the moment. You can certainly get your money's worth. We've got lenders giving 4 grand rebates. We've got other lenders giving up to 300,000 Qantas points. So there's a lot of things out there in the marketplace whereby you can refinance, consolidate, get a lower rate, review your loan term. When we refinance, we typically want to keep you on the same loan term you're on, but get yourself in a better position financially. So guys, that's it for me today here at Hunter Galloway. We're based in Brisbane. We deal with people Australia-wide. We work with home buyers, investors, refinances. So if you need assistance, you're based in Perth, you're in Adelaide, Sydney, Melbourne, wherever you're based, give us a call on 1300 088 065 or visit us at huntergalloway.com.au, and we'll see you next time.